Our next guest prefers the overseas markets right now. Joining us to discuss is David Herro, Harris Associates Portfolio Manager. You always prefer the overseas markets, David. Do you expect other central banks, overseas central banks, to begin cutting this year? And is that part of the thesis?
But that's not really why I have such a strong preference over investing in overseas markets today. It's because of where value exists. At Harris Oakmark, we're value investors. We think a company's valuable if it's a good quality business that generates a good, strong cash flow stream. And we measure this by valuation levels. And if you look outside the United States, in particularly in Europe, you're able to find extremely high quality, well-managed businesses that trade at ridiculously and in almost all-time low valuation differentials. So whether you look at price to cash flow or free cash flow yields, and you look at what's happening in terms of their businesses, they're doing fine, they're still growing their earnings, and yet we see PEs in, for instance, the German market of around 10, 11 times, free cash flow yields over 10%.
David, you have been arguing this for years. I mean, you could have said this for years. What makes now different?
Because we keep getting more extreme. It's a very good point. I would argue, first of all, that, of course, foreign stocks should trade at some discount to U.S. stocks because business performance is generally better for U.S. stocks. But that discount has tended to be 8 or 9%. Now we're pushing a couple standard deviations beyond this. And these businesses, though they're based in Europe in particular, they do business all over the world. If you take the auto producers, for instance, BMW, Mercedes, only 1/3 or so of their business is even in Europe. The rest of it's in Asia and the U.S. And yet these are companies that trade at 4 times earnings and yield 7 or 8%. And in the case of BMW and Mercedes, healthy shareholder returns, big stock buybacks. But you're right. It keeps getting bigger. The discount, I'm not arguing that you're wrong. The discount keeps getting bigger, but at some point, we believe fundamentals will assert themselves and that the value of financial asset, its cash flow stream, will in fact be recognized by investors.
Listen, the long-term track record of Oakmark would also point to that. So I want to give you your due. That said, to Sarah's point, it's been a long time. I mean, investors these days, David, just seem to like one word, it's growth. And they say it over and over again. And you're just on the wrong side of that trade. So what will have to happen for you to end up being right?
You know, sometimes the teeter-totter gets way overbalanced. If you look at what happened, for instance, the last time us value investors had our real strong heyday was 2000 to 2007, 7 years of strong outperformance. It's when you really saw out-of-sync valuations. Now, I would argue the valuations are even more out of sync. So I believe this is positioning for a value renaissance. I know it's been long, but eventually fundamentals of buying an undervalued asset, an asset that generates cash for its owners, will come to fruition. Now, you're exactly right with social media and algorithmic trading and strategic trading. All these things are shielding fundamentals, but I don't believe it will last forever. Eventually, markets will price cash. And especially as we go into this more normalized, higher interest rate environment, don't forget for the better part, and in fact, more than 10 years, we've had funny money where growth and non-fundamentals could fool investors. And even though we've had this realization for the better part, a year or so, perhaps it's not quite enough. Perhaps it hasn't sunk in that we are not going back to the funny money days, which means value will play a more important role.